Assalamu alaikum. This video explains acquisition of mineral interests in property in oil and gas accounting. We will talk about property ownership. We will compare the various types of mineral and royalty interests. We will talk about mineral or economic interest, overriding royalty interest, production payment interest, net profit interest, and pooled or unitized working interest. But in the beginning of this session, I would like to thank my son Muhammad Abdullah Khan, who gave me an iPad and the necessary accessories, without which making these videos would not have been possible. I would like to thank Nabiya Khan for helping me out in preparing these awesome videos. I would also like to thank my wife Samina Siddiqui, who helped me in compiling information from various sources for this video. Let us start with property ownership. Ownership means to be an owner, having the legal title of something. The primary difference between buying and leasing is ownership. When a person buys a piece of land, he owns the land. Many rights are associated with ownership of land, such as rights to use, rent and sell it, cut down trees, build structures, extract material, hunt, and so on. Leasing is like renting, when you are renting on a long-term basis from the owner for a specific period of time. Leasing rights mean that you do not need to own the property in order to use and benefit from it. In most countries, when individuals buy land, they get surface rights to an area of land. This means they don't own the minerals below that land. In areas where drilling or mining occurs, the ownership between the surface of the land and the minerals beneath it is often severed. In such cases, the surface rights owner have no royalty rights to the minerals that are extracted from beneath the land. However, there are laws that protect surface owners and make them feel more comfortable with oil companies drilling on their land. I would also like to add that there are few countries like United States where citizens can own minerals, oil and gas below the land surface. In America, the landowners own both the properties above and below the surface. An ownership of both surface and below surface is called a fee interest. Land can be owned by an individual or government. There may be oil below the surface, but unfortunately the individual or the government may not have the resources or the ability to explore oil. So the landowner or the government can lease the land to an oil and gas company who gets the rights to explore, develop and produce oil from below the surface. Let us now talk about the types of mineral and royalty interest. Royalty interest and the mineral rights can be classified into two broad categories. There may be perpetual rights and there may be non-perpetual rights. Mineral rights are going to be for the owner of the property and he will be getting the royalty interest. He is not going to be a part of the production process. He will simply lease the land to a oil and gas company. These perpetual rights can be non-participating royalty interest as well, and they are carved out of the mineral interest. They are similar to mineral interest, but the difference is that they don't have executive rights to negotiate lease. They do not receive lease bonuses or delay rentals as a mineral right owner is going to have. Non-perpetual rights may be overriding royalty interest, and these are carved out of lessee's leasehold interest. The overriding royalty interest burdens working interest and not the mineral interest. It expires with underlying lease from which it is carved. Working interest holder, he has the right to participate in drilling activities including income and cost from the production. They are burdened with the capital cost and lease operating expenses. Almost exclusively, they are owned by the exploration and production companies. Let us now talk about mineral and economic interest in more detail. How much an owner owns over the land and how much they are entitled to receive from the extraction or sale of the minerals below the surface is determined by the types of mineral interest. 100% mineral interest in a property means that the person has the full executive rights to the minerals found or on beneath the land. They can explore the minerals, develop them, and arrange for mineral production. Or they can sever their rights below the surface to an oil exploring company and receive royalties, rental payments, and lease bonuses for the minerals found on the property. Thus, the original owner retains full control of the surface, while a completely separate individual or company owns and manages the mineral rights. If the owner possesses less than 100% of the mineral interest, then they can own fractional mineral interest. And I would like to add an important concept over here: dominant state. The surface owner has the right to use the surface for farming, building a residence, building apartments, etc. If the mineral rights are owned by one party and the surface is owned by another, the surface owner must allow the mineral rights owner to explore and produce. That's why mineral interest is stronger than surface interest and is called dominant state. Although the surface owner is entitled to compensation for any damages that may result from exploration and production operations. Let us now talk about the concept of fractional interest. Individuals who inherit the mineral interest from their parents or grandparents end up owning fractional mineral interest. Let us take an example. Khalid left with 100% mineral interest for his 4 children. Each child owns 25% of the mineral rights. When these children pass away, the rights will be transferred to their offsprings. Each offspring will get further a fractional mineral interest. Who owns mineral interest is what we are going to talk about in the next slide. Mineral rights can be owned by individuals or government. In case the mineral rights are owned by the individuals, the oil and gas companies must obtain a mineral interest by executing lease agreements with the individuals. In many countries other than America, the mineral rights are with the government or a government entity, such as the Ministry of Petroleum. So the oil and gas companies must obtain a mineral interest by executing lease agreements with those governments. Let us now talk about the types of mineral interest. There are two types of mineral interest: royalty interest and working interest. The owner of the mineral rights has the royalty interest when he enters into a lease agreement with another party, the oil exploring company. He receives either a specific portion of the minerals produced or a specified portion of the gross revenue from selling the production. He does not share any cost of exploring, developing, or operating the property with the oil company. Although he is responsible for any severance or production taxes assessed on his share of production from the property. Historically, 1/8 of the gross revenue has been commonly paid as royalty. Let us now talk about working interest or operating interest as we call. The oil and gas company gets the working interest when they enter into a lease agreement with the owner of the mineral rights. The working interest owner is responsible for paying all 100% of the cost of exploring, drilling, developing, and producing the property. However, their share of revenue is the amount that remains after deducting the share of the royalty interest and other non-working interests. Let us talk about the mineral and working interest with the help of an example. Abdullah owns mineral rights for the land he owns in Calgary. Abdullah leases this land to Black Gold Oil Company and receives 1/7 of gross revenue as royalty interest. The working interest owner, the Black Oil Company, is responsible for paying 100% of the cost of exploration, development, and production. After paying the 1/7 of royalty, the company would retain 6/7 of the gross revenues. The royalty interest owner Abdullah would receive 1/7 of the gross revenues and pay none of the exploration, development, and production cost. Let us now talk about post-production cost. Post-production cost include costs related to the transportation of the saleable product, cost necessary to get the product into marketable conditions such as dehydration, compression, and liquid extraction cost. Because the royalty interest owner is not responsible for the exploration, development, or production, a royalty interest is often referred to as a non-operating interest or non-working interest. Let us now talk about divided and undivided interest. A working interest can be divided or undivided. In an oil and gas industry, working interest is commonly shared by the companies for two reasons. First, costs and risk can be distributed, and second, companies can invest in other properties too. The working interest companies are grouped as operators. They manage the day-to-day operations of the company. And non-operators, they share in the joint ownership of the underlying assets. Let us take an example in this regard. Black Gold Oil Company acquires 900 acres of land in Calgary from Abdullah after agreeing to pay him 1/8 royalty interest. Identify divided interest or undivided interest in the following two situations, assuming total cost was 750,000 riyals, while the total revenue was 1,250,000. Now, in this case, Abdullah the landowner, his royalty interest is 1/8 of 1,250,000. That will be equal to 156,250. Black Gold Oil Company will be having the 100% working interest, and this is equal to 1,250,000 minus the royalty paid to Abdullah, that is equal to 1,093,750. We also call this as net revenue interest, or that means that the 7/8 of gross revenue interest is equal to 100% of net revenue interest in this example. The Abdullah will not pay for any cost that Black Gold Oil Company will incur for exploration, development and production. Black Gold Oil Company has to bear the entire cost of 750,000. Let us now look into the first case and analyze whether it is a divided or undivided interest. In the first case, Golden Oil Company sells 40% of the working interest to Pioneer Oil Exploring Company. So, the cost that will be shared by the two companies, Black Gold Oil Company will share 60% of 750,000, that is equal to 450,000, while Pioneer Oil Exploring Company is going to bear 40% of the total cost, that is equal to 300,000. And that's how we verify that how the cost will be shared by the two companies. Regarding revenue, remember that Abdullah was paid 1/8 of the gross revenue. So the balance is 7/8. And 7/8 of the gross revenue from this 60, and that is equal to 1,093,750, and 60% of this amount will be claimed by the Black Gold Oil Company, that will be equal to 656,250, and for Pioneer Oil Exploration Company it will be 40% of 1,093,750, that is equal to 437,500. Okay. So that's how the cost and revenue is going to be allocated if it is a undivided interest, because in the first case Golden Oil Company is selling 40% of the total working interest. Now let us look into the second examples or second case. Golden Oil Company sells 100% of the working interest in 360 acres of land. Now here they are selling 100% in 360 acres of land, that is 40% of 900 acres. So in this case, the Black Gold Oil Company will get 7/8 of the gross revenue generated on 540 acres of land, and they will bear 100% cost incurred on this land. Pioneer Exploration Oil Company, they will get 7/8 of the gross revenue generated on 360 acres of land, as in either case 1/8 of the gross revenue will be given to the landowner. And Pioneer Oil Exploring Company, they will bear 100% cost incurred on this land. Let us now talk about overriding royalty interest. An overriding working interest is a non-working interest created from working interest. As already explained, that the subsurface rights can be separated from the surface rights, and this creates two kinds of subsurface interest: working interest and royalty interest. Oil and gas companies lease subsurface rights from mineral owners through a working interest lease to explore, drill, and produce the mineral reserves. In exchange, the landowner receives a royalty interest in the mineral estate. Oil and gas companies grant overriding royalty interest to fund operations to investors, geologists, landmen, and lawyers as compensation for their services. Thus, the overriding royalty interest is carved out of the working interest or lease. It is an undivided interest in a mineral lease, giving the holder the right to a proportional share of the sale of oil and gas produced. An overriding royalty interest is different from royalty interest. The royalty mineral owner retains ownership of the interest after production stops. Holders of overriding royalty interest have no ownership rights to the minerals. When the lease expires, the interest reverts to the mineral estate. Let us calculate overriding royalty interest. The revenue remaining after the royalty interest is paid out of the working interest is called the net revenue interest. If you are the lessor of an overriding royalty interest, you will receive your proportional share of the working interest lease based on the net revenue interest. So, net revenue interest is equal to working interest minus royalty interest. The royalty owner receives monthly royalty of 15% of the monthly gross sale of 2 million. So, if the royalty interest is 15%, the net revenue interest will be 100 minus 15, and 100% of working interest was 2 million. Minus 15% of 2 million, that is equal to 300,000. This is equal to 1,700,000 monthly royalty interest, monthly net revenue interest. A geologist would then receive monthly royalty check on 10% of the net revenue interest. So, overriding royalty interest is equal to net revenue interest multiplied by the percentage, and that is 1,700,000 times 10%. So, this is equal to 170,000. So, the overriding royalty interest is 170,000. Let us talk about the types of overriding royalty interest. Overriding royalty interest can be created in two ways. First, retained overriding royalty interest, and second, carved out royalty interest. Carved out means to create or obtain something that helps you by skillful activities. In case of retained overriding royalty interest, the owner of working interest sells its working interest and retains the overriding royalty interest. Let us look into an example over here. A Black Gold Oil Company acquires 900 acres of land in Calgary from Abdullah after agreeing to pay him 1/8 royalty interest. Later on, Black Gold Oil Company sells its working interest for 75,000 to Pioneer Oil Exploration Company and retains a 1/9 overriding royalty interest. So, in this situation, Abdullah, the landowner, will receive 1/8 of gross revenue from the property, and the gross revenue is, and Black Gold Oil Company will receive 1/9 of net revenue interest. Pioneer Oil Company, Oil Exploration Company, will pay all the cost of exploration, development and production. Abdullah or Black Gold Oil Company are not going to share anything as far as cost is concerned. Let us look into a carved out overriding royalty interest. In this illustration, Black Gold Oil Company decides to develop the property. So they are not selling it. So Black Gold Oil Company is short of capital. It approaches Pioneer Oil Exploration Company, who agrees to pay the company 1 million, and in exchange Black Gold Oil Company agrees to give 1/5 overriding interest in the lease to the investor. So again Abdullah will receive 1/8 of gross revenue from the property. Black Gold Oil Company, they have 100% of the working interest, but they will receive 4/5 of the net revenue interest, as 1/5 goes for the overriding. The company will pay for exploration, development, and production, and Pioneer Oil Exploration Company, they will receive 1/5 of net revenue interest. Let us now talk about production payment interest. Like overriding royalty interest, production payment interest are also created from working interest. The objective of creating such interest is to obtain capital to explore, develop, and produce. In case of production payment interest, payments are limited to a specific amount of oil or gas, or money or time, after which it reverts back to the interest from which it was created. If the payment is to be done in terms of money, then it is stated as the percentage of the working interest share of revenue. If the payment is to be done in terms of the product, that is oil or gas, payment is stated as a percentage of the working interest share of current production. Now let us look into an example here. Like suppose the gross revenue interest is 100. Abdullah is going to have a royalty interest of 1/5. So 100 times 1/5, that will be equal to 20, and this is the royalty interest payable to Abdullah. The balance amount is the working interest, and this is equal to 80%, as 20% is for the royalty, and you can say it as 4/5 of 100, that is equal to 80. That means 4/5 of gross revenue interest is equal to 100% of net revenue interest. So working interest we have just now calculated is equal to 80, and this is also what we call as net revenue interest. So the royalty payable to Abdullah is 1/5, and the revenue interest is 4/5. 100% of working interest is 4/5 of the revenue interest. Or now Black Gold Oil Company transfers working interest to Pioneer Oil Exploration Company and retains 1/10 of the net revenue interest as overriding interest. So 10% of working interest, this will be equal to 8, or you can also say 1/10 of net revenue interest, that is 1/10 into 80, that is equal to 8. It is just to make you understand the concept. Pioneer Oil Exploration Company now will be having how much? 80 minus 8, that is equal to 72. That means Pioneer is going to have 90% of working interest of Black Gold Oil Company. So 90% of 80 is equal to 72. You can also say that 9 upon 10 of 80 is equal to 72. Now, Pioneer Oil Company carves out or sells production payment interest to Red Sea Oil Company, and they agree for 2% of working interest of Pioneer Oil Exploration Company. Now, Pioneer Oil Exploration Company was having the working interest equal to 72. We have calculated just now. So 2% of this amount is equal to 1.44. So let us see now what happens. Abdullah has still the royalty interest of 20%. Black Gold Oil Company, they are having 1/10 of the net revenue interest as overriding interest, and both Abdullah and Black Gold Oil Company will not pay for any cost incurred in production of oil. Pioneer Oil Company retains 9/10 of net revenue interest, and Pioneer Oil Company will pay for all the cost. Red Sea Company will get production payment interest of 1.44, and even they are not going to pay any cost, or they are not going to share any cost with the Pioneer Oil Company. Next, let us talk about types of production payment interest. Production payment interest can be created in two ways: retained production payment interest and carved out production payment interest. As previously explained, carved out means to create or obtain something that helps you by skillful activities. In case of retained production payment interest, the owner of the working interest sells its working interest and retains the production payment interest. Let us look into an example of retained production payment interest. Black Gold Oil Company acquires 900 acres of land in Calgary from Abdullah after agreeing to pay him 1/8 royalty interest. Owing to shortage of funds, Black Gold Oil Company sells its working interest for 75,000 plus 70,000 barrels of oil to Pioneer Oil Exploration Company and retains 1/5 of the production payment interest payable out of the Pioneer's working interest share of production. The total production during the first year was 100,000 barrels. In this illustration, Abdullah, the landowner, will receive 1/8 of the gross revenue property, 1/8 times 100,000 barrels, that will be equal to 12,500 barrels of revenue. So the net revenue interest will be 100,000 barrels times 12,500 barrels is equal to 87,500 barrels. Black Gold Oil Company will receive 1/5 of net revenue interest, that is 1/5 into 87,500, that is equal to 17,500 barrels. The balance of barrels owed to Black Gold Oil Company is 70,000 minus 17,500. So that is equal to 52,500. Pioneer Oil Exploration Company, they will receive 4/5 of net revenue interest, that is 4 upon 5 times 87,500, that is equal to 60,000 barrels of revenue. Pioneer Oil Exploration Company will pay all the cost of exploration, development and production till they hold the working interest. After Black Gold Oil Company receives a total of 70,000 barrels of oil, Pioneer Oil Exploration Company will cease to have the working interest, and Black Gold Oil Company will get back the working interest. Let us now talk about carved out production payment interest with the help of an example. In this illustration, Black Gold Oil Company decides to develop the property. Now, in this case, they are not selling their working interest. Black Gold Oil Company is short of capital. It approaches Pioneer Oil Exploration Company, who agrees to pay the company 1 million, and in exchange, Black Gold Oil Company agree to repay the principal amount plus 12% out of 25% share in production. Assume that first month's production was 900,000. Now again, Abdullah will receive 1/8 of gross revenue, that is equal to 112,500. The net revenue interest will be 900,000 minus 112,500, that will give you 787,500. Black Gold Oil Company owns 100% of the working interest and will receive 7/8 of gross revenue interest, or we can say 100% of net revenue interest. Black Gold Oil Company will pay $196,875 to Pioneer Oil Exploration Company. The remaining balance payable to Pioneer is 1 million plus 1 million times 12%, and because it is monthly, so 1 upon 12 minus 196,875. So when you solve it, this will be equal to 813,125. The company will pay all the cost of exploration, development and production. Since Black Gold Oil Company kept its working interest and created a production payment interest, the production payment interest is referred to as carved out production payment interest. Next, we will talk about net profit interest. Net profit interest can be created on onshore properties and offshore properties. Let us talk about each one of them. Net profit interest can be carved out from the working interest in onshore properties. So we have Abdullah, he has the mineral rights, he sells it to Black Gold Oil Company. So Abdullah has the royalty interest, Black Gold Oil Company has the 100% of working interest. and Black Gold Oil Company carves out a net profit interest to Pioneer Oil Exploration Company. So Abdullah has the royalty interest, Pioneer Oil Exploration Company has net profit interest, and Black Gold Oil Company has working interest. Next, we will talk about net profit interest created from working interest. Net profit interest is created from non-working interest in offshore properties. In case of offshore properties, the government is the mineral rights owner. It is like a royalty interest, except that the government receives a specific percentage of net profit and not gross revenue. The lease agreement lays down the items deductible from the gross revenue to calculate net profit. Interestingly, the net profit interest owner is entitled to a percentage of profit, but they are not responsible for any losses. Although such losses can be recovered from non-working interest owner from future profits. Finally, let us talk about pooled or unitized working interest. Every business tries to work efficiently and economically. One such way is to pool or unitize the working interest. This type of interest is created by combining the working and non-working interests of two or more properties. Thus, each interest owner owns the same type of interest but a smaller percentage in the total combined property. Pooling and unitization are referred to combining of lands into a unit large enough to meet government regulations for drilling, etc. Pooling refers to the combining of undrilled acreage to form a drilling unit. A drilling unit is the area that can be drained by a single well. The term unitization refers to a large combination involving an entire producing field or reservoir for purposes of enhanced oil and gas recovery. So this completes this session on acquisition of mineral interests in property. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any questions regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.